Plan for financial success. Understanding your credit report. Have you ever taken the first steps of ordering your credit report? You will see that although different bureaus use different formats, the type of information on all of them is basically the same. Most often, the printed reports use a series of codes and abbreviations that are designed to be read by computers, not humans. These notations can be difficult, if not impossible, to read and comprehend. The bureau, however, is required to give a clear explanation of its terminology. Often, only the intelligible entries will be your name, birth date, address, social security number, employer, and your spouse's name and employer. Unfortunately, sometimes even this information can be wrong if your credit history has somehow been crossed with another person. Because the purpose of the information is to help a lender decide whether you are at good credit risk, your report will usually include the payment history of your bank loans, any major retail accounts, terms, amount of the original debt or credit limit, and the balance outstanding on the most recent report or bill. Your credit report will also include a list of inquiries by any credit grantors who have accessed your file in the last 6 months. Credit-related information that is a matter of public record. For example, bankruptcies, foreclosures, judgments, or tax liens will also appear. In addition, more and more frequently, the state agencies in charge of enforcing child support agreements are reporting delinquencies in child support payments. What is not on your credit report? You may be surprised that your credit report does not describe your checking, savings, or any other major assets in your bank accounts. Furthermore, unless a debt collection agency has been given your account, you probably will not be cited for owing money on oil and gas cards, utility bills, medical bills, or attorney fees. A credit bureau's report is not a financial rating. Your potential creditors usually evaluate the report and decide for themselves how much of a potential risk you may be. However, some credit bureaus now use a scoring system to help creditors evaluate your creditworthiness. They instruct lenders to identify credit-related factors such as income, length of employment, and payment history. Then they assign various point values to each characteristic, resulting in a score that either meets or does not meet the lender's requirements. Personalized debt elimination plan. The personalized debt elimination plan is a strategy designed to help you get out of a debt and on your way to financial freedom. Using this strategy will help you cut the amount of time necessary to pay off your debts while saving you a tremendous amount of money on interest. Although there are many steps involved in this process, it is not complex and it can be followed by anyone willing to make the following commitments to becoming debt-free. Number 1, agree to not taking and on any additional debts. That means no credit card spending or loans required. Step 2, commit to making consistent payments every month. Step 3, commit to spending less money than you earn every month. Step 4, analyze and alter your spending habits to stay within your personalized debt plan. Reasons for keeping a good record system. To track your personal progress for each financial goal. Step 1. Step 2, to always have financial information available to complete financial applications and statements. Step 3, to provide documentation for IRS and tax purposes. Step 4, for proof of payments to creditors and lenders. Steps to getting organized. 1, locate a permanent area in your home or office to use for work storage. 2, purchase or locate file folders to be used for document storage. Step 3, purchase a file cabinet. Setting up a filing system. Setting up a filing system for bills, statements, contracts, and receipts. Step 1. Step 2, keep recent and 1 year or more documents in different drawers of your file cabinet. Step 3, describe how you will or would like to sort or group your filing system. Sort and label all financial and personal areas within your filing system. The list of items below contains some suggested categories that may be appropriate. Bank and checking accounts by bank, including statements, etc. Credit card statements, correspondence and monthly purchases or records. Credit bureau reports and updates. Creditors, employment records and benefit information. Health insurance, medical bills, doctor and hospital information. Home or rental, mortgage documents, blueprints. Car information, car insurance, titles, etc. Educational information, including diplomas, degrees, certificates, resumes. The length of time you should keep certain records or types of records. Keep these records for at least a year. Receipts for food and clothing, utility bills, receipts for tax-deductible items, insurance policies with no outstanding claims, canceled checks for deductible items. Keep these records for at least 7 years. All tax records. All supporting documentation for tax records. Canceled checks for tax-deductible expenses. Commit to maintaining your personal spending records. A spending record is a daily, weekly, and monthly log of all your personal spending and expenses. It's a tool that will assist you in keeping an eye on your financial situation. It is also one of the most important tools used for eliminating debt. Before you begin to eliminate your debt or change any of your financial or previously problematic spending, you must have a clear understanding of exactly where all your money is going. Most problematic debtors cannot explain how much money they have spent in the last month or remember their purchases. Any attempt to fix the problem will end in failure if you're not sure exactly what the problem is. So the first step is understanding the problem. This can also be accomplished through the clarity and understanding of your spending habits, which results from tracking all your expenditures. How bad is impulse shopping? Impulse shopping accounts for half of all retail shopping purchases made in America today. Likewise, because this shopping is done on the spur of the moment, few people compare prices for quality and price. Not as surprisingly, we end up spending about 3 times more money than we had planned on in any given shopping trip. Because it is so easy to shop impulsively, when one does not have to pay for a purchase with cash, building substantial debt can happen quickly. Tip 1. I love to shop at Macy's. I like Cole Haan, Claiborne, Sean John, Kenneth Cole. But I also like to be smart about my money. Before I go to the store, first I go online and the internet and compare prices. Then I go try on the stuff at the neighborhood store. If it is cheaper online, I buy. Either way, I do my homework before impulsively buying so I can make the most of my money. Evaluating your spending habits. If you are like most Americans, it may be hard for you to track exactly where all your money goes every month. Most can account for rent, mortgage, car payments, insurance, utility bills, grocery bills, and credit card payments. However, for most people, that only accounts for 60 to 70% of your income. So where does all of the rest of the money go? Well, let's take a look at tracking your income and expenses every month. This will give you a good idea of your spending habits and will allow you to discover where changes may be possible. Many people may be afraid of looking at where their money goes. Others might find it to be a tedious endeavor. The fact remains that knowing how much money you spend is critical to your financial success. Examine your spending habits will allow you to change them, spend less, and begin to invest the difference. Bankruptcy. 2 types of bankruptcy. Chapter 7 and Chapter 13. Chapter 7 of bankruptcy is also known as a straight bankruptcy or liquidation. In this type, your state court appoints a trustee who is responsible for determining if any of your assets are available to be sold to pay off your creditors. In Chapter 7 bankruptcy, you retain the right to certain exempt property, as exemption laws vary from state to state. Only a bankruptcy professional can advise you on which property you can most likely lose. In most consumer bankruptcy cases, most of your assets, including your home, furniture, and automobile, may be exempt or partially exempt. When you have completed a Chapter 7 bankruptcy, you are legally discharged of your obligation to pay off unsecured debts. Generally, this included personal loans, credit cards, utility debt, medical debt, and other debts that are not attached to collateral. Other unsecured debt, including tax debt, student loans, and court payments, are not likely to be discharged. A Chapter 7 bankruptcy does not prevent your secured creditors from recovering their debt through seizing and selling your property if the debt is not repaid. The bankruptcy does, however, prevent the creditor from suing you for the difference after your collateral has been sold. In most cases, Chapter 7 bankruptcy will not cover the following types of debt: credit card charges made within 40 days of filing, most student loans, criminal fines or traffic tickets, debts resulting from another or any fraudulent situations, possessions converted to exemption within 90 days of filing, some taxes including back taxes, most fines payable to government agencies, debts owed for child support and alimony, debt attached to collateral, debts you have agreed to pay regardless of bankruptcy by reaffirming your responsibility. Tips. Reaffirming can be defined during a bankruptcy as agreeing to pay the debt you are obligated that was eliminated by Chapter 7. For example, let's say that you owe money on your car and it's not exempt in the bankruptcy. If you lose the car, then you will not be able to get to work, earn money, and pay off your debt. The creditor may decide to exempt the vehicle and allow you to work to keep your income. In a Chapter 13 bankruptcy, you receive protection from your creditors and additional time to pay off your debt instead of being discharged from it altogether. It is basically a reorganization of your debt, along with a plan for payment. Chapter 7 bankruptcies require you to submit a plan that explains how you will repay your creditors over a certain period of time. This is where most of the consumer reorganizations take place. Although Chapter 13 may not sound as attractive as Chapter 7, it has many distinct advantages. Advantages of Chapter 13 bankruptcy. It carries less negative reputation than bankruptcy associated with Chapter 7. You are not obligated to give up your personal possessions. You may file Chapter 13 bankruptcy an unlimited amount of times. Tax debt and some student loan debts are forgiven under this bankruptcy if you prove they will create a substantial financial burden. You too established enough income to pay your living expenses as you are paying down your debt. You have the opportunity to make payments on your debt in good faith and show cause to future creditors so they are not liquidated under Chapter 7 filing. You may change your status to a Chapter 7 bankruptcy at any time. Disadvantages of Chapter 13 bankruptcy. The court may be denied this filing if they believe that you are abusing it. You have to stay on a strict budget to keep your payments up. You are only allowed to file this bankruptcy if you have a steady job and income and your debt is within certain limitations. Most of your earnings are dedicated to payments of debt.